Let's kick it off with the markets because those key inflation data prints that are going to be out this week are going to give us a little bit more insight maybe onto the Fed's next moves on rates. Bank of America CEO Brian Moynihan urging the Fed to cut rates in September. In an interview over the weekend, he said, quote, "It's time for the Fed to take the restrictions off." Joining us now to discuss what's next, we want to bring in Kenny Polcari. He is Case Capital Advisors managing partner. Kenny, it's great to see you. So let's just first take a step back. Coming off what was last week, a very, very tumultuous week here for the markets. We're setting up for what could be another volatile week here for stocks. What should investors be doing or anticipating here ahead of those key econ prints that we will be getting?
Well, a couple of things, right? Good morning. Nice to have you. Nice to be with you. A couple of things, right? Last week was a very, very volatile week. On Monday, there was a lot of internal damage done to the market. So investors need to understand that it's going to remain volatile, and we're probably going to have to retest those lows over some period between probably now and the end of the month. Tomorrow's PPI and Wednesday's CPI are going to be key factors in inflation. They are supposed to come in a little bit better than the expectation. So that's going to help the argument that the Fed needs to start cutting rates. Does the Fed need to start cutting them drastically by a half a basis point or 3/4 of a basis point? I don't think so. I think a 25 basis point move is really what the market is expecting. I think that's what a lot of economists are expecting, but I think street analysts are expecting for a bigger move, which I think would be a mistake. So I think investors need to understand the data that's coming. They also need to understand August is kind of a funny month, right? There's a lot of people on vacation, so there's a lot less volumes. And so moves can be exaggerated in either direction based on the data that comes out. So don't put too much thought into it as you have to kind of watch as the market reacts to the data without getting too impatient, right? Patience at this time is very much a virtue.
Kenny, do you think there's a chance that we are overpricing the likelihood of a huge market reaction to this data print, given that the market has particularly been concerned about the labor market so far versus the inflation data? And the real question has been about a growth scare, not about an inflationary scare.
I think the market is now very sensitive. It's overreacting to both, to all the economic data that comes out, right? If the CPI number is better than expected, I would expect another overreaction, demanding that the Fed needs to cut rates. They need to cut it sooner rather than later. They need to make a bigger cut. I think the Fed is actually doing the right thing, especially after last week's Monday move and the calls for an emergency rate cut meeting. And oh my God, the world was coming to an end. In fact, they sat back and they said, slow down. We're watching it. We understand we have it under control. And look, the market kind of rebalanced, did not completely, which is why I think there's still concern. But I think you have to be careful, especially in August, that the market overreacts either way to the expectation. Although I do think that there is some reality to a slowing growth story, not necessarily a crash, but certainly a slowing growth story, and that's okay considering from where we came.
Well, so again, Kenny, what do you make of the comments from Bank of America CEO Brian Moynihan really pushing for a September cut? If we don't get a cut in September, there's lots of talk about 50 basis points, but what if we don't even get 25? Would that be a mistake?
I think we are getting a cut in September. I think we're going to get 25 basis points. I think actually a 50 basis point will be the mistake. I don't think at this point.
Why, Kenny?
As long as the data continues to be what it is and the CPI and PPI continue to be better, I don't see how the Fed cannot cut. They've prepared the markets for a cut. They've been talking about it. They didn't prepare the markets for a July cut, and so we didn't get one. But they are preparing it for a September cut, and I think 25 basis points is right, and I think Moynihan is correct.
But Kenny, why would 50 be wrong? Is it just because that risk that you still see here to the upside for inflation?
No, I think 50 would be wrong because 50 in my mind would suggest that, that the Fed is behind the 8 ball and now they're trying to play catch up because they see something more negative on the horizon. So I think 50 basis points just gives the impression that we missed it. We're trying to catch up, and that would create some concern. I think if they stick to 25, that's what they've been saying all along. I think that would help the market smooth out.
Kenny, I want to shift gears a little bit and talk about the election. In the notes that you sent over to us, you had a quote saying the Biden-Harris years have been a, quote, disaster for the economy. Talk to me about where you stand in your thinking on what either candidate's potential in the White House come November could mean for the economic path here moving forward.
Well, it's very interesting. We kind of know where Trump stands in terms of the economy and policies that he'd like to implement. we still have not heard from the other side. We have not heard from Kamala Harris's campaign on what her policies are. She's out there waving everybody, saying, I'm going to change things and I'm going to do this and I'm going to do that. But there's no policy. You go to her website, there's no policy. So we still don't know what Kamala Harris and that ticket is really planning in terms of policies. We do have a sense with Trump. We understand where he wants to go. He's been very clear. We have a history with that. We don't have one with Kamala Harris at all, and she's not really putting one forth, at least not yet. And that's causing more uncertainty and lack of clarity in the markets. At some point, she's going to have to stand up and say, look, this is the policy. This is the platform. Maybe we're going to get it this week at the Democratic National Convention. Maybe. And if we do, then it'll be clearer for investors to kind of assess, okay, here's what he thinks, here's what she thinks, and where are we, right? Where are we as investors in terms of where do we think it should go?
So, Kenny, what should investors then be doing when they're trying to position their portfolio? There's a slew of uncertainty out there. Should they be making any changes now, and why or why not?
So I think as a long-term investor, here's what you have to do. You have to, at this time, I think if you're going to add more money to your portfolio, you have to add it defensively. So you have to think of kind of big, boring names, consumer staple names. You got to think of utilities, which are the most boring sector in the whole group. But at this time, especially if rates are going to go lower, utilities will benefit, right? NEE is a great name. That's still down 12% from when they started raising rates 2 years ago. So if they start cutting rates, NEE is going to be one of those names that benefits from that. And it already is in anticipation, right? Consumer staples are another kind of boring group, yet they're good dividend payers. And look, there's stuff that we need. Procter & Gamble, Kimberly-Clark, Johnson & Johnson. Those are all things, whether we're in a recession or not, that consumers are going to need. So you got to get a little bit more defensive. Now, if we see a big pullback in some significant names, whether they're tech or otherwise, NVIDIA was off 30% by Wednesday night. Now, it rallied a little bit on Thursday and Friday, but it was off 30%. That was a screaming buy for me. Whether or not you like tech or not, or you think, you shouldn't be in tech because it's too nervous, down 30% in NVIDIA when the story hasn't changed was a real opportunity for the long-term investor that's looking out 5, 10, 15 years, right? And so that's how you have to position yourself. But if you're really nervous about what's going to happen over the next 2 or 3 months, which is a seasonally weak time of year in the markets anyway, August to October is seasonally weak. The market tends to go lower. Then either you do two things: you get more defensive with the boring names, consumer staples, utilities, or you put your money in treasuries, earning 5% or 4.5%. That is also an investment decision.
Right. That's certainly some activity that we are starting to see, Kenny. Thank you so much for joining us. That was Kenny Polcari, Case Capital Advisors Managing Partner. Thanks so much.
Bye-bye.